right, good evening, everybody. Thanks for coming out. I really appreciate Mark taking the time. I know he said he told me he has about 30 minutes. He's going to be able to kind of come up here, introduce himself, go through some of the previous court cases, some of the more recent court cases, give a little debrief of what he can share of his involvement with Mullen at the time, and then go through some of the comments if there's some time at the end for a little bit of Q&A. Mark, how are you doing tonight? Let me go ahead and make you co-host.
Yeah, can you guys hear me?
Yep, hear you, Mark.
Okay, great. Great to be with you, Ernest.
Thanks for coming out. Really appreciate it. I know a lot of investors are pretty excited. The news dropped, was it now 2 days ago, about you joining the Mullen team and helping represent us in certain endeavors. And then I don't know how excited you are about today's news. If you've heard, I'm sure you have. There's a little extra information, a little news dropped in an 8K filing today with Mullen as well. But I don't want to sidetrack from that. I'd love for you to maybe introduce yourself to any new investors that maybe haven't really done a deep dive into what yourself and your firm do, and then if you can go into any form of detail of your representation with Mullen. I know that it needs to be publicly disclosed information, so I'm totally okay with that. And then if you want to go over some of those court cases, some things that you think would be applicable to our situation, and then just anything else in general.
Okay, thanks. So I'm a former law professor at a law school in New York. I've been fighting dilution funding for about 14 years. What I do is not as glamorous as what Wes and Alan do, and certainly not as high profile what Wes and Alan do. But we kind of do. We kind of have the same kind of mission creep. What my firm does is we do three things, but they all revolve around dilution funding. And if all of you don't know, any company you're invested in who's taken dilution funding, you're actually paying back that funding. The company's not. And dilution funding, from the metrics that we've had and all the cases that we've had, and looking at the markets in general, looking at Wes's cases, going back a couple of decades, I can safely say that dilution funding causes about 80% of all legal and naked shorting. Because the way it works is, and you have a lot of sophisticated retail investors in the Mullen community. And just for those who don't know, when you take dilution funding, the company is committing to issuing shares in exchange for funding. And the way those shares are issued is either through what's called a convertible note, which is a security, a convertible preferred stock purchase that converts into common shares at some sort of discount to market. That's called a security. And usually with one or two or independently associated warrants, which are also securities. And the reason why I want you to understand that a promissory note, which is convertible into stock, is a security, is going to matter as we further go into what dilution funding is and how dilution funding kind of works. So my firm does three things, right? So the first thing we do is when a dilution funder sues one of our clients, we determine which state law applies. And a lot of states have what's called a usury statute. Now, that sounds kind of archaic, and it is, because that comes from the 1700s, from the King's Court of Appeals from London, where the first codified usury laws actually existed. And that basically says, when you have a threshold of a certain percentage that you're allowed to charge on the loan of money. So if you understand a convertible note is also a loan of money besides a security, when that transaction's features violate the usury percentage limit thresholds of certain states like New York, Florida, California, Texas, Massachusetts, and a whole bunch of others, Illinois. In those states, a violation of the criminal usury laws voids the transaction. Now, just to give you some context, and I try to be as transparent with everybody as possible. So, we've represented many OTC companies against these small toxic dilution funders that are out of New York. And anytime they sued our clients in federal court, we would raise the defense of criminal usury. And we've had 11 decisions go against us at the trial court level. So I really got my head bashed in by a couple of these trial courts. And I knew they were wrong. I knew that, these guys really want to, explore immigration laws and sue Trump and whatever. They're not really so sophisticated on finance. So I appealed one of the cases to the Second Circuit Court of Appeals. And the Second Circuit said, hey, wait a second, Mr. Basile, you may be right, but we're not telling our 11 lower court judges they're wrong. We're going to punt this over to New York State's highest court, called the New York State Court of Appeals, and we're going to let them decide what the legislature meant behind codifying the usury laws. So a year of litigation goes on there, and at the end of the day, we win all issues. That decision is handed back down to the Second Circuit, and the Second Circuit started vacating judgments awarded to dilution funders to get stock, to get cash, whatever. Ever since that decision in October of 2021, we have basically put out of business the toxic convertible note lending market in New York, at least on the OTC markets, because they don't want to test whether or not their portfolio of loans are all illegal and void, which means you don't have to pay back the principal. All right. Now, some of you, may be hearing, oh, that's not fair. They took the money. It doesn't matter. They took the money, the issuers. The lenders violated the law, not the issuers. So it doesn't sound like it's equitable, but that's how the law is written, and that's the statute. So that really deals with the situation where these toxic dilution funders sue the issuers. But what about the toxic dilution funders that have already extracted millions and millions of dollars from the issuer based upon a $100,000 note? So the way these notes work is, $50,000 or $100,000 are loaned to the company, and then the lender converts stock at a 30 to 40 to 50% discount to market, and it does it in tranches. Like, so a $50,000 note will get converted $10,000 at a time each week. But as it drives the price of the stock down, the percentage discount still applies to the new lower stock price. So they're just getting more and more and more stock for the same amount of money that they're converting. And that's where dilution funding cripples public companies, not just the OTC companies. So we came up with a way to use the usury laws offensively through the federal RICO statute, the civil RICO statute. The civil RICO statute says, if you engage in the collection of an unlawful debt defined as violates a state's usury laws, then not only do you have to give back the difference between what you lent them and what you collected, but you have to give back 3 times that amount. Oh, and by the way, you have to pay their legal fees as well. So we've commenced several RICO actions under that statute. And every time we beat a dilution funder on a motion to dismiss, they run to the table, they want to settle. Because if we prove that that transaction violates state law, then every transaction that they've ever done violates state law, then the state attorney generals go after them. So that's the second thing we do. The third thing we do is, believe it or not, exactly what the SEC has been doing to a lot of these dilution funders. There's a statute under the Securities Act called 15A. 15A says, if you are engaged in buying and selling securities as a business for your own account through a broker or otherwise, you have to be registered as a dealer. And Section 15cc of the Securities Act says any violation of this act voids the transaction. So that's kind of been interpreted a couple of ways. First, it's been interpreted, first of all, it's a hard and fast rule. If you buy and sell convertible notes, so if you buy a convertible note, convert it to stock, and then sell the stock in the public market, and you're doing it as a business, which means more than a few times a year, you have to register. If not, that transaction's void, but you have to go to a court and have it declared void. The difference is that in a case where it's a new transaction in the last 3 months and they haven't converted or exercised warrants, the idea is we cancel that transaction. You just have to pay them back what they funded the company. But think about all the potential dilution that has just saved the entire retail shareholder base, right? That's critical. Now, in situations where the funder has extracted, so say it's a $10 million funding, and the funder extracted $100 million from an issuer. If you win that dealer registration argument, they owe the company $90 million and our legal fees. So the way that I usually work with companies, I'm not going to speak about any specific company on this part, but I usually make a handshake deal with the CEO that if you get back money from these unlawful fundings, you need to at least express to me that you are going to provide a dividend to your retail shareholder base, a cash dividend based upon whatever you collect. Because it's only right to return to the people who paid for it, which is the retail base. So anyone who has bought into a stock for a short play has to kind of love what we do, because we're going to knock out that overhang. We're going to knock out that future dilution. That future dilution will never hit the market. And chances are the market's already been plagued by short selling and naked short selling. You know, they're rubbing their hands thinking, okay, you know, a shit ton of stock is going to hit the market in a couple of weeks or a couple of months. Let's start shorting it down now. And now we know there's going to be a lot of stock hitting the market that we can cover our positions on. And that's why I believe about 80% of all legal short selling and naked short selling is all born out of dilution funding. So if you look at an issuer, say, take a look at GNS, which may not be the best example now, but GNS, you know, used Wesson Allen and filed a lawsuit. And actually the lawsuit, you know, was kind of recognizable to us because they kind of used some of our prior lawsuits as a guide for them, right? And you know, they were entering into a big battle with a couple of these big dilution funders, right? And Roger Hamilton called me up and said, look, you know, this is your expertise. You know, we need to bring you in on the team. We need you to kind of look at this, and we want you to help us file an amended complaint and go after them. I said, great. You know, I can't wait. This is, I live for this kind of shit. So he puts out a press release. The stock goes up 25% that day, and every one of those dilution funders ran to the table and settled with him before I even had a chance to start. I'm not saying that that's going to happen in all cases, but the dilution funders know the statutes that we use against dilution funders are the same exact statutes that the SEC is bringing civil enforcement actions against these clowns for unregistered dealer activity. And guess what? In every single civil case against a dilution funder that the SEC has brought under 15A and 15CC, they have won summary judgment. They've also won final judgments, disgorging all profits for any funding that they've ever done, millions of dollars of fines, sanctions, penny stock bars, you name it. So the only difference on a dealer registration issue between what the SEC and what we do is the damages. They get disgorgement, right? They get fines, they get penalties. we get what's called rescissionary damages. So between us and that dilution funder, you get all the money back under rescissionary damages, less what they originally funded the company for. And that takes, that takes an analysis, and you have to work the numbers and stuff. So if you take a 20,000 foot view and you look at what Wes Christian does and is fairly successful at what he does, he sues the brokers, right, for manipulation under 10b-5, consisting of stock spoofing and naked short selling. Okay. He starts if he wins a motion to dismiss, he starts his discovery and starts drilling down into the brokers to see if there's any other accomplices or any other brokers working in concert with them or whatever. I sue the funder. And when I sue the funder, all my discovery is with their broker and where did the stock go, what other brokerage firms and other brokerage accounts. And we get all the trading records, we get everything that they've made on the transaction, because that goes to our damages. And somewhere in between that discovery, Wes and I will meet, because we will start crossing over when we get to that point in our litigations on discovery. Now, what he has when he gets out of discovery really can't help what we do. But what we get out of discovery certainly can help what he does. So that's the 20,000 foot view. And we've already had successful civil cases. We're the only firm in the country that has successfully prosecuted 15A defenses and 15A claims. And one of our clients, I see Raul here, he's a big shareholder in one of our clients called Dark Pulse. We just got 2 state court judgments against the dilution funder that not only canceled all the transactions, but awarded our client monetary damages and all their legal fees. And this is a pattern that's now developing because the issuers are waking up. Some of the issuers are waking up and saying, we didn't know these things were illegal. So I don't see how they did anything wrong. Maybe retail communities don't like the idea of dilution funding, but unless Goldman Sachs is coming with a 10% discount, we're just going to buy straight common stock and we're going to be a long-time holder for 3 to 5 years. What are your options as a startup company, especially such a cash-intensive company for capital like Mullen and like a lot of other companies? So what we do, if anybody's in it for a short squeeze, they should love us, because the whole idea is we're going to take that stock away. That we're going to take that ability to get that stock through a warrant, through a conversion, and we're going to try to cancel it out and void it out. And then the company really, under the Securities Act, will only have to pay back what it was funded, right? That's how the law is. That's what the law states. I'm not making up something. And the hedge fund guys and some shills will show up in spaces and say, "Oh, poor funders, why, they made a deal and they, your client took the money." You can't see this. I'm Italian. I'm putting my hand under my chin and I'm pushing it forward. That's what I think of these people, because they have no problem diluting the crap out of these companies on your backs, on your investments, on your public market investments. They have no problem doing it, driving the freaking price of the stock down, where you guys are, you're struggling to build the wall and struggling to keep it from falling even further. They played you, not the company. The dilution funders played you. So, I kind of take this a little personally for communities I get invested in. And that's what my law firm does. We're basically the only firm that's doing this. So
now, Mark, let me ask a quick question. These lenders that become beneficial owners of a portion of the company and have these excessive amounts of warrants, is it legal for them to place puts on the company or place a short position on the company knowingly that they're going to exercise the warrants and drive down the stock price?
Well, I don't want to comment anything on any specific company, but you can't short on a warrant. It has to be an actual stock that you own, not a contract to acquire stock. You can't do it. There's a federal court case in Georgia. I think it's called, I want to say Mr. Krabs, but I'm thinking of stupid thing. I think it's Crab something. I'll send it to you, Ernest, and you can post
Okay.
it. Federal court said you can't legally short against warrants. But I think that's what either they're shorting against the warrants or they're shorting with the expectation that the warrant's going to be exercised and a shit ton of stock's going to hit the market and allow them to cover. So I
Right.
don't know if it's the funders that are shorting, although Savvy Management was just pinched by the SEC in a civil action for naked short selling. How about that? Didn't the SEC and FINRA said there's no such thing as naked short selling? And didn't Forbes and a whole bunch of other magazines and Bloomberg say there's no such thing as naked short selling? And why did the SEC commence an action against Savvy Management for naked short selling? So these are all things that the better educated you are on the law and the mechanics on how the market works, you guys are going to make way better investment decisions going forward. So,
Mark, one more follow-up question, then we can maybe move on to some of the other topics. So recently, Rule 13F2 was adopted by the SEC. It's a form, I'm sure you know about it, for institutions. Institutional managers have to now report their short sale information to the SEC. Do you see that benefiting some of the smaller cap companies and some of the OTC companies?
if they comply with it, a little,
Yeah,
yeah, a little bit if they comply with it. But, the problem is we don't have market transparency. Whether it's an issuer you can't get any answers from, whether it's FINRA because they're tight, whether it's the SEC, whether it's the brokers. Um, there are a couple of recidivists online that talk about the back end, talk about how they short and why they short and point to charts. You know, shorting to me is a very important issue. But remember, Ernest, what I do is cut off the shorting, but I really don't engage into prove shorting or naked shorting. I leave that to Wes and Allen. That's what they've been doing for decades, and they're pretty good at putting those pieces together. But yes, I believe anything that provides more market transparency for the retail investor, not to protect the institutional investors, I think is a
right.
great thing. I think they should publish it every day before the open of market, from the day before. I think you should know who took what short positions in your stock that you're trading in, because that will definitely have an impact on your trading decisions. Absolutely.
Okay. And another thing, just to kind of clarify another definition, if an investor is reading a filing and they see that their company is getting a contract with a lender for an equity line of credit, that is that another form or another definition for dilutive funding or dilution funding?
All right. So you know what I think of equity line of credit? Bullshit. It's just another way of dilution funding. It's just the mechanics are a little different.
Okay.
The lender or the funder is still getting stock directly from the company and then selling it in the open market. That's the definition of a dealer. And that's just another bullshit dilution funding tool. So,
And Mark, a lot of times when companies, I'm trying to keep this very general. A lot of times when companies um, sign up for some of that dilutive funding, they also have to have anti-dilution clauses in place. That way, the lenders are protected from any type of negative price action on those warrants that they're being granted to exercise at a later date. So when you're going after these companies and you're able to prove that that there's illegal activities going on, if the company that is being held or at the mercy of these lenders, if they've had to exercise additional supplemental prospectus filings with additional warrants just to try to make up some of that anti-dilution clause or that verbiage in terms of I guess keeping that same equitable pricing for that initial contract. All of that is also going to all that would play into factoring exactly what the final settlement amount would be. Is that accurate, or am I off topic here?
well, I mean, look, anti-dilution clauses really mean dilution on top of dilution.
Right.
So let's not beat around the bush. These anti-dilution provisions are solely to protect the funder. Why? Because the funder wants a risk-free funding. He wants a risk-free funding. A funder takes no risk. If you look at the SEC decisions and the SEC enforcement cases on dealers in Fife and Almagarby and Keener and Octus and LG and Crownbridge and Fiero and Irongate, whether it's an administrative enforcement proceeding or a federal federal lawsuit enforcement proceeding, it's the same thing. There's no risk to them, right? Because all they keep doing is getting more and more stock to cover. Right. Then they have these penalty provisions, which in my cases, we've already determined that those penalty provisions are void as a matter of state law. They want these make whole provisions, which is just another way of saying we're gonna dilute on top of dilute and then dilute you some more. So these documents are constructed solely for their benefit, to reduce almost to zero their risk on investing in these companies. That's why when they invest in these companies, you think they're doing massive due diligence? Look, a real investment from a legitimate brokerage firm, legitimate registered brokerage firm, takes months to put together because of the due diligence. You know how fast these transactions are? 2 weeks, 3 weeks. They want to look at your trading volume. They want to know if they can sneak in there when it comes time to convert or dilute, if they can kind of bury themselves in the volume and not be seen. That's exactly what they do. And then after talking about Wes's case a little earlier today in another site, another space call, you guys better break out the puke buckets, because if you read the new Mullen complaint, that made me sick. Forget about you guys, and I understand the law behind it. I mean, it's disgusting. You guys are fighting a retail battle with one arm tied behind your back, and you have no legs, right? You have your mouths and one hand is flailing around. That's what it's like. You're subject to thousands of trade orders done in a millisecond. So you can't even react fast enough. So, that's another reason why I want to kill the dilution funding. Look, if it's legitimate and legal dilution funding, that's fine. But if it's unlawful and illegal, why should you guys suffer? And that's how I look at it.
Absolutely. And Mark, we're coming close up to that 10 o'clock period. I did want to ask you, maybe you gave a couple of court examples of some of the cases that you've won recently. I can start kind of skimming through the comments for any questions that you may be able to answer.
Well, there's a couple of cases. Dark Pulse versus EMA in the Southern District of New York. We brought a RICO action against the dilution funder. They made a motion to dismiss the case. Judge Schofield, who wrote the same opinion in the Harrington case for Wes, was also our judge in that case. And they said, no, you guys, looks like you guys violated the criminal usury statute. These loans are usurious. So we got a great decision on that. We just beat one of the biggest law firms in the country, Gibson Dunn, in the Ninth Circuit Court of Appeals against another dilution funder called LGH Investments. The Ninth Circuit Court of Appeals reversed the lower court dismissing our case, saying, hey, wait a second, no, these guys have a California usury claim, which, by the way, mimics the RICO claim. And in that case, they took $12 million in warrants. So that's a big case. That's $35–40 million right there. We won a first in nation decision on the if a conversion discount to market is interest in New York State, which put out all the in Adar Bays versus Genesis ID, which basically put all the toxic lenders in the OTC market out of business. And we just won 2 judgments in the Careborn Capital versus Dark Pulse case in Minnesota, where the court granted us summary judgment and awarded us a final judgment on dealer registration violations for a dilution funder that did about 25 transactions in the last 2 years, got over 1 billion shares of stock, and the court ordered those the balance of the contracts canceled all the securities, and awarded our client monetary damages. And we have a huge oral argument coming up next the 13th. I'm not sure if that's Tuesday or Wednesday, in front of the Second Circuit Court of Appeals, which is the only Circuit Court of Appeals that has not addressed the dealer registration issue. That starts at 10 o'clock. You can listen to the oral argument at the Second Circuit Court of Appeals website starting at 10 a.m. on the 13th. We're number 4 on the calendar, so we're later in the morning. If you want to, hear how the judges, asking our firm questions, asking our adversary questions, which is from another big firm, Kirkland and Ellis, and you'll get to see my firm in action, at least on that issue. So if you guys have any other questions, I can stay like another 5 or 10 minutes. So.
Yeah, Mark, let me just do rapid fire. And of course, any of these, feel free just to pass on some of these. First question, I put them up in the nest as well, so kind of can read through it. Someone asked if a company is at risk of being delisted. Has NASDAQ ever granted extensions if the company can prove manipulation in court? So I think this one definitely plays a key role in our specific company, Mullen Automotive.
I'm not sure if that's been tried, but it would sound like if you have proof, like a court decision, or some other hard proof, which you would think that the NASDAQ or the New York Stock Exchange would be able to look at their trading records on an issue and kind of see the anomalies. It could give you more time. I don't know if it will. That's up to the discretion of the committee.
Okay. And some of these, I think they'll be pretty quick. Another one said, I think they're talking about the dividends that you mentioned earlier. They asked if they're paid to retailers who were holding during that time, or is it paid to all retailers, even the new ones who just got in?
Can you say that again? You were breaking up.
So for the dividends, because you had talked about that a little bit earlier on, this person's asking if the dividend would be paid to retailers who were holding during that specific time of the infraction, or would the dividend be paid to all retailers, even new ones who just got in?
Well, I think in order to make it fair, the company's going to have to assess and have maybe different categories regarding issuing dividends. I mean, there are people who held and lost value. There are people who sold and lost value. And then there are people who bought and lost value, right? So, it's up to the company on how they want to structure that. But I would like them to be fair.
Right.
Because,
And that, yeah, that makes a lot of sense. A lot of investors have been through 2 reverse splits with this specific stock, so they've got all their QSIP numbers, and I'm sure they're able to get all that documentation together. So I could see how it wouldn't necessarily be a standardized kind of payout for investors if that's the route that's taken. But just want to get your take on that. Another person asked, how can we investors have bought shares in Mullen? How can we be part of the case if and be benefited by the result? So right now you're representing Mullen, the company. Is there any way for the investors themselves to be part of a class action lawsuit against these same type of lenders?
There are rules that will allow a class action by shareholders against the lenders. So sometimes you need to get the board of directors' permission, because what you're doing may be counterproductive to what they're doing regarding any lawsuits they commence. I don't do class action work. I don't recommend class action work because the class action attorneys are the ones that make the most money. It sounds counterintuitive since I'm an attorney, but since I don't do that kind of work, depending on the case, you've heard of stories, $1 billion fraud or whatever, and then you get a check for $2.90. Yeah. So that's not cool. But you'd have to really ask like a class action attorney, and then it depends on the state rules of incorporation, on if you have to get permission from the board first or whatever the case may be. Sometimes you have to let the board know, and the board under certain state laws has 30 days, 60 days, or a reasonable time to respond. Yeah, we're going to do it, or no, and these are the reasons why we don't want you to do it. And then maybe they make some sense, maybe they don't. I don't know. I can't really speak to that.
Okay. only two more up here. Another one, and this may not necessarily have any relevance for your specific part in all this, but someone want to know if the dark pool volume has any kind of factoring in maybe what your firm would be going after in terms of, the I guess the proving some of the dilutive trading. Are you able to have a look into the dark pool section um, and track any types of trades in that manner?
That may only come into play on the damages aspect after we win the subject matter law on the case. So that may or may not come in. Usually it's the trading is usually back and forth, whatever. We can't get loss of market cap in what we do. We could just go back to the dilution funder or funders and claw back whatever they took out of the market, less what they funded the company. And then, that's why what I do is not glamorous. It's effective. I have a lot of court decisions on that, and it's very effective, but it's not glamorous. It's like really pit bull kind of, dog eat dog. It's a dog fight with these guys, and it's going to be a dog fight. Whatever Mullen decides to do, in any of its cases, it's going to be a dog fight because when it comes to money, people don't want to give it up. So,
Yeah, absolutely. And just my own personal opinion, I definitely see how Mullen's taken a stance in many different facets of the market right now for the investors. So I see that as a very positive thing. But the last question someone had asked, why does the SEC not enforce companies to go through only registered brokers to get loans? Are there any types of legislation, any bills that are currently out floating around now that potentially would help kind of solve some of these issues? Or do you think this is just something that investors are going to have to continue to deal with?
there is a proposed rule floating around right now where a lot of high-powered law firms that represent these dilution fundings are meeting with the SEC and fighting against. But there are rules to expand dealer registration. Right now, it's really simple. It's read the statute, stupid. Right? That's what we call it to other attorneys. Just read the freaking statute, stupid. It says, if you're buying and selling securities, which is defined what a security is, as a business, the 11th Circuit Court of Appeals defined what as a business is, through a broker or otherwise. So whether you're part of a group that invested or individually, you have to be registered as a dealer. And if you can't affect a transaction, meaning you can't even enter into a securities transaction, and you can't perform that securities transaction. It's either or, right? So a contract could be legal on its face. So picture this, Ernest. A 13-year-old contracts with you, right? You didn't know he was 13 years old. He was 6'3", he's like Baron Trump, whatever the case may be, right? And you contract with him. You later find out he's 13 years old. He did not have the legal capacity to enter into that contract with you. You can seek to have that voided. It's the same concept. This is not rocket science. These dilution funders are going to throw in all different things. Oh, they're investment advisors. Oh, they were registered at one point, but not anymore, and blah, 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 blah. We saw it all already. It doesn't matter. Just read the statute, stupid. I may post it up tomorrow or Friday for everybody to read, and I'll tag Mullen so you can see this. It's the statute. It's not judicially made up law, where sometimes we have to fight, where the courts get it wrong and the people think that's precedent, and then they're wrong, and then we have to appeal. And we're 100%. Our appellate record is 100% so far, and we've won like 11 appeals. So whether we're right or wrong at the state, at the trial court level, we've won every appeal that we brought. So that says something. That doesn't mean we're always going to be right. It doesn't mean we're going to, continue that batting average, but it's indication that the stuff that we do is embedded in the statute. So you can't reword the statute if you're a judge. You have to follow what the statute says. So, look, I'm as transparent as can be. I talked to David. I said, I'm coming on this space. I'm going to talk in generalizations. He goes, go at it. I want my shareholder base to know who you are and what you stand for, and we're glad we're working with you, and what have you. So I try to be as transparent. I don't like death threats against me, which some of your community members already did. And I was sent some bogus cease and desist that was so factually incorrect. I had to choke back my coffee. I was laughing so hard. And quite frankly, I don't put up with bullshit. So if somebody's going to call me out, expect me to come after you. Expect me to talk to you online, because I want to clear the air. I don't want FUD circulating. I don't want people to get the wrong impression. I'm against dilution funding. I'm against, I'm against naked short selling. I'm against anything illegal that you guys are the victims vis-a-vis the issuers. And sometimes I deal with. I won't take a case if I think a CEO is a bad guy, but I have to learn everything that he's done, what he's done, and why he's done it. So I'm comfortable with David. I've been involved, and Ernest, you and I have gone back and forth a little bit. I've been involved in a prior EV company that was private. It's very hard to raise money. And they had the first EV truck called Zero Truck that was out and sold a couple of hundred units. So I understand this market, and I think that's why he brought me in to kind of do a 20,000-foot view on all their fundings, and make different recommendations to the board, and how we can improve things going forward, and what we can do about the past and stuff like that. That's as detailed I'm going to get with you at this point. So.
Well, I really appreciate it, Mark, and I'll speak on behalf of retail. I'm sure you see a lot of the comments and responses, but appreciate you taking the time with this investor base just to be transparent. I feel very good. I feel reassured on what your company's doing, what you're doing, and I'm excited for the future and the filings and all the information that we have coming down the pipeline. I'm very optimistic for what's to come. And in terms of dilution funding and everything like that, another aspect that I think is rather interesting is whenever you have a reverse merger, and not only are you getting the company's assets and this and that, you also get stuck with some of the dilution contracts that are already in place. So some of these companies, when these reverse merge, or some of these lenders, when these reverse mergers happen, they end up kind of getting rolled into it all, and you kind of get pregnant with some of these lenders and entities like that. So it's just it's been a quite a ride, I would say, as a Mullen investor over the last 2 years or so, and I'm excited to see all of the legal actions that are now getting put in place. I see a lot of great things operationally, and now I'm seeing some really good signs from the company in terms of getting legal to kind of go out and fight to kind of protect that share price and to protect those investors. So I appreciate your time, Mark. Appreciate you staying over a little bit. Hopefully I can have you on another space call. Maybe after you have some public filing or anything out there, and they have a great opportunity to kind of maybe break some of that down, or just have you in for another chat.
Yeah, well, if you guys don't hear from me, for a little while, don't worry. I'm working behind the scenes, and I'm working with the company. And I'm kind of glad to be working counter on the other side from Wes and Alan, because I think their Harrington decision basically opened up the lawsuit that was filed today by holding the brokers responsible for what their clients' orders are. You can't just have blinders on and say, "Oh, the client's doing. I'm just placing an order." No, you've got a responsibility. You're a registered broker. You've got to report. So I think that that's what happens in law. Nothing is ever really set in stone, and it takes sometimes weeks, months, and years to chip away at certain things to finally get to the point where now you're changing dynamics. You're changing, in this case, you're changing market dynamics. And the more cases that are brought for spoofing, and the more that the issuers stand up for the retail base and go after the dilution funders, if they have grounds to, then I'm cheering you guys on. You hear me. This is the way I am in court. So you may not like how I say certain things, or I do curse, and that's just coming from New York and growing up the way I did. But I use that as an expression for content. So it's not like I'm trying to be vulgar. I just want you guys to understand.
Yeah, I appreciate that, Mark. Absolutely. One final note, as you said, it could be a little bit before we kind of hear from you. I just wanted to know, it sounds like your firm and yourself, you're definitely going after the dilution, the potential dilutive funding agreements and stuff that's happened in the past. Do you ever work with companies to help them broker new funding that basically your team's able to kind of skim over just to verify that it's ironclad and that to help to kind of protect the company moving forward?
Well, my firm not only goes after dilution funding, we've also did private restructurings and workouts for many OTC issuers. So, in my prior life, long time ago, I was a Chapter 11 attorney when I was with a big firm in Manhattan, and I learned a lot of tricks on how to resolve debt, how to restructure debt, how to restructure basically organizational functions and administration, how to make it operate leaner and smoother and more effective. And I bring all that to the table, So, um, there's, I have much more business experience than I do legal experience, and I have 35 years of legal experience. So, I look at everything with from a business perspective on making recommendations, and I'm very fiscally conservative. So if that translates into some of the things that I recommend to the company, then so be it. That's just me. And that's why I'm running for George Santos's seat in New York.
All right, Mark. Well, again, I really appreciate it. I'm excited. I really hope you stay part of this mullen community. And long term, it sounds like not only can you help us with some of the history that we have, but it sounds like you're a great person to have on our side in terms of future dealings and things like that. So again, appreciate the time. Thanks for staying over. If you want to hop down, I will start bringing up some of the mullen retail to kind of just have a kind of a spin-off chat. So
All right, guys, have a great night, and hopefully we'll get together soon.
all right, thanks, Mark.
Thanks.